Thanks for clicking. The world might be at a tipping point of government debt binges. This according to Noel Quinn, CEO of HSBC, at a recent summit in Saudi Arabia. The comments come amid another dismal U.S. Treasury auction this week, being called horrible by some, showing plummeting international appetite for the growing level of U.S. debt. Following the auction, the yields on Canada's 5-year government bonds, the yields which dictate our mortgage rates, popped upwards, following that of U.S. Treasuries. And while we talked about growing U.S. debt woes putting upward pressure on Canada's mortgage rates in other videos on this channel, the issue is gaining in importance and was even brought up at the Bank of Canada's press conference on Wednesday.
In the NPR, you talk about one of the downside risks. You talk about bond yields not having been this high since before the 2008 financial crisis. How concerned are you about the potential for a global economic slowdown?
Say nothing, because you said the wrong thing.
Yet, despite the clear impact that U.S. debt problems are having on our own cost of borrowing, on our own mortgage rates, and our own bond yields, the news focused almost solely on whether or not the bank was going to be able to cut rates going forward, with almost zero attention being paid to the Bank of Canada's response to rising U.S. Treasury yields. So we'll address it here. So what I want to do today is go over how the Bank of Canada addressed rising Treasury yields at the press conference, take a look at the specific structural problems facing the U.S. which are sending yields higher and hence sending mortgage rates higher, and then discuss what to look for next. Speaking of next, the end of the month is fast approaching, and with that we're expecting to get October's real estate data out from the local boards late next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get back into this press conference. As mentioned, the Bank of Canada governor was asked directly if rising U.S. Treasury yields would create a problem for the Bank of Canada going forward. For her part, the deputy governor acknowledged that bond yields have been increasing lately and that one of the reasons for that rise in yields is the U.S. deficit.
There's also some structural elements. The U.S. deficit means there's a lot more bonds being issued in the U.S. market, and that increased supply has to be absorbed, which is going to push prices up a bit.
Now, I think the deputy governor misspoke and meant yields, which are inversely related to prices. Now, very briefly, as we've talked about this at great length before, but it is going to be important later, the price of a bond and its yield are inversely related. For instance, if I buy a bond from the government for $100 with a 5% coupon, at the end of the 1-year term, I'm going to get paid $105. I am yielding 5%. However, Jen comes along, and although she wants the bond, she's concerned about inflation, so she's only going to pay me $95 for that bond. I get my money now, Jen pays $95 for that bond, gets $105 at the end of the term, Jen is yielding 10%. The price of the bond dropped, the yield on the bond increased. And that's what the deputy governor was talking about, with worries over inflation continuing and so many U.S. Treasury bonds coming to the market. Prices of those bonds are falling. Econ 101, supply and demand. When you increase the supply of something without increasing demand, the price of that thing is going to fall.
I had to quit school in 11th grade.
And there are a lot of bonds being auctioned off by the United States right now. At its most recent auctions this week, the U.S. saw soft demand for both its 2-year and its 5-year Treasury bonds. This put even more focus on the November auctions set to happen in a couple of weeks, as the U.S. is set to increase the number of bonds it's auctioning off. So, the U.S. had weak demand for the bonds that it was selling last week and is set to sell even more bonds next month. And this is where we get to the heart of the problem. U.S. needs for new debt is structurally not expected to decrease anytime soon. Let's take a very brief look at the U.S. deficit, the difference between how much the U.S. spends in a year and how much money it brings in. Right now, in 2023, the U.S. deficit is sitting at $1.7 trillion. The U.S. is spending $6.1 trillion per year, but only bringing in $4.4 trillion. And, as any household knows, when you spend more than you bring in, you have 3 options. Either make more money, spend less money, or borrow.
I'm going with option B.
Of that $6.1 trillion that the U.S. is spending in 2023, the largest items are Medicare, Social Security, defense, and most importantly, interest on that debt, totaling $4.3 trillion. Close to what the U.S. brings in taxes. And, with the exception of defense, all of these expenditures are mandatory, meaning the U.S. doesn't have a choice. These programs are on autopilot. They have to pay Social Security, they have to pay Medicare, they have to pay their interest costs. So, the US has to make all of these mandatory payments, and it hasn't paid for anything else yet. It hasn't built a road. It hasn't paid for any income security. It hasn't paid for police or done anything else. It's just paid for what it has to pay for. In that other line item, the interest cost, the $670 billion set to pay out this year, is about to explode, as the US now has to refinance $7.6 trillion of its debt next year alone. All of that debt that the US took out over the past 15 years at 0, 1, 2, and 3% now has to be refinanced. Those old bonds have to be paid out with new bonds at rates at 4 and 5%. The US, just like a lot of mortgage holders here in Canada, has to pay out old, low-rate debt with new, higher-rate debt.
Welcome to the show.
In fact, if we don't see any changes by 2027, it's estimated that U.S. interest costs alone are going to hit $3 trillion per year, which is a lot considering it's only expected to bring in $4 trillion.
Now you know what it feels like.
This is expected to lead to a $3 trillion deficit per year versus the 1.7 that we have right now. And all of this means is that by 2027, 3 years from now, the US is going to need an additional $3 trillion in new loans every single year.
You got a couple of fuzzles.
And this is a structural problem. Like we just saw, none of these major expenses are optional for the US. Maybe defense, but as we'll see, that's not likely. So the US is going to need an additional $3 trillion per year, and as we've seen, there isn't a whole lot of appetite for US debt at current rates when it only needs $1.7 trillion per year. And as investors come to realize the extent to which these deficits are not sustainable, these structural deficits are not sustainable going forward, some, including Columbia Business School professor Charles Calamares, say that we could see future bond auctions fail, where the US can't raise the money it needs at the interest rate it wants to pay. Were that to happen, if the US had failed treasury auctions where no one wanted to buy its debt, where the banks, the pension funds, international central banks, Chinese central banks didn't want to buy US debt, then the Fed would be forced to step in, which, as we've all seen, definitely brings with it inflationary pressures.
Really?
Now, as we've mentioned, these are structural problems for the United States, meaning that the solution isn't so simple. When we look at Social Security, Medicare, Medicaid, these aren't really optional programs for any viable US politician. These are the third rails of US politics. You step on them and you die. So, those programs aren't getting cut anytime soon. And, beyond the Fed printing, interest costs aren't getting cut anytime soon either. That leaves defense spending. Is the US going to cut defense spending anytime soon? Not likely. Even with all of these structural problems, all these deficit problems, the US is increasing its defense budget by 3.3% next year. And with all of the problems arising throughout the globe, it's not clear that they're going to be cutting back anytime soon either. So, here we are, US structural debt needs over the next few years, over the next 3 years, far outpacing its own ability to finance it, and also far outpacing anyone else's ability or willingness to finance it. Now, back to the Deputy Governor, who was pressed on US yields later on in the press conference.
For Mortgage Logic News, Rob, go ahead, please.
Hi, Governor and Senior Deputy Governor. In a scenario where U.S. Treasury yields were to continue running higher, not because of inflation, but because of concerns over U.S. deficits and Treasury supply, could those higher yields be inflationary or disinflationary to Canada, other things equal? And what kind of risk would such a run-up in U.S. yields create for Canadian monetary policy?
Hi, Rob. Thanks for the question.
He really doesn't look exactly confident, does he? For her part, the Deputy Governor spoke briefly in terms of the bond market trying to front-run monetary policy, get ahead of monetary policy, but also, more importantly, spoke about yields in terms of trying to add to monetary policy, add to monetary tightening.
The degree that the increase in yields is sort of adding to what central banks are doing, it could be a bit of an offset to future increases. But it's really hard to disentangle the effects on yields. And to your point, I mean, what we've seen in the U.S. is not the same degree of increases we've seen here in Canada. So remains to be seen, I guess.
Okay, next we've got Amber.
Again, the body language here, not exactly confidence-inspiring. So, Governor Macklem and Deputy Governor Rogers aren't really answering the question. In fact, they look rather reluctant to answer the question. And, depending on how you look at it, that's for good reason. Absent the money printer, there is really no good solution to this problem. Not that the money printer is a good solution either. This is a structural problem. Social Security, Medicare, Medicaid, these are all outlays. Interest costs, these are all outlays to which the U.S. has previously agreed. The U.S. can't default on these obligations. And the magnitude of all of these obligations far exceed the U.S. ability currently standing to finance them. But the main point of all of this is that U.S. structural debt needs is far outstripping international or domestic players' ability to finance it. Yet, when we look at the news articles following the Bank of Canada's press conference, this big, massive problem, which was at least sort of addressed at the press conference, is not mentioned in any of the major news sites. It's not mentioned on the Financial Post, on Bloomberg, on Yahoo News, etc. We only see when can we expect with the Bank of Canada to lower rates, which, as we saw today, as we're seeing in the Treasury market, as we're seeing at the dismal Treasury auctions, there is a big structural problem occurring south of the border, which will dwarf any rate cut that we might see from Canada's central bank. With that said, we will continue to track what happens in the US and how that affects us here in Canada. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.